Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, macbethmcleodpartners.com. You can find him on Twitter at HMacB. Welcome back to the show, Hilliard.
It's my pleasure.
Hilliard, fears are cropping up now amongst business owners, especially tourist operators and restaurants that were hard hit by the pandemic closures with federal aid about to wind down in September. Is that a real fear in the business community right now?
Well, I don't know if the business community is thinking that far ahead. It's, September's still a long ways off. There's still a beautiful summer to enjoy. But it'll hit them. People tend to live these days. They tend to live a very short time horizon. And but even before the pandemic hit, there was this developing sort of shortage in some jobs. I think it wasn't really a true shortage. It was they just weren't paying them enough wages. Right? If there is a salary or a wage where there'll be 100 applicants, there's a price, but then the problem becomes then the profit margins for the business shrink, and no business owner likes that. But that seems to be where we're headed. We are seeing. I think the number that came out today on Producer Price Index was a 7% increase, and most of that was in services, which would include restaurants and that sort of thing. And then yesterday we saw in the U.S. core CPI and headline CPI both around 5%. So you can't say that that's temporary, transient, or whatever the other T word is, transitory, I guess. Anymore. I think people have to start saying that, this might be with us for a while. And if that's the case, that has a huge amount of implications for other things in the financial markets.
Yes, we had a labor shortage going into the pandemic, and there's always a hunt on for skilled labor. An Ontario engineering firm is offering their employees $20,000 for a down payment on a home if they promise to work for that firm.
Yeah, the down payment on a home at $20,000. The price increase in Toronto was probably on the average home was probably $100,000 last year. They're still $80,000 worse off in Toronto than they were 12 months ago. Although that again could also be temporary and transient. But the problem of salaries and wages is going to be with us for a long time, and I think they're going to have to go up. I mean, I had it on my our chart that we publish every month around the middle of the month, so it's coming up here pretty soon. Shows house prices, household debt, inflation, and then wages. And wages and salaries were only going up just slightly ahead of the rate of inflation, way below the amount of household debt that's increasing every year and the house price gains every year. So people are going to be looking at Toronto and Vancouver and other big cities and saying, why should I work there for a wage that hasn't really grown much at all in 10 years, when the cost of living has probably doubled in 10 years? So it's especially now with work from home, there's a lot of people rethinking all these options.
Yeah, I also saw a headline that people in Ontario were thinking of moving out of that province because of the high cost of housing.
Yeah, I was at a golf resort in BC, and I golfed with a couple of different people that had permanently moved from Toronto to this place near Vernon, British Columbia. So I don't know. It's going to be interesting. I would love to interview them a year from now and say, how are you enjoying this very quiet, could we use the word boring life compared to what you were used to in the fast-paced big city? But they seemed very happy. And one of them had been there 5 years, so I guess they've adjusted to it. So if that's possible, and they can probably still, I think both of these people were no longer working, but you can also continue to do some jobs could be you could still be working full time and be in the interior BC somewhere. And house prices are going up there as well, but nothing like Toronto. So you'd still be ahead. You could probably pocket $500,000 towards your retirement and make a move like that and still keep working.
You were mentioning as well before we went to air that some U.S. financial firms are giving their employees substantial pay raises because I think they can see with baby boomers retiring, a lot of them decided to take early retirement during the pandemic, that if you're going to pull out of this, you're going to have to retain your skilled workers.
Yeah, and those skilled workers, I mean, I guess, with the computerization and artificial intelligence and all that, the definition of a skilled worker keeps changing, but there's a certain core employees that the company needs to keep going, and they aren't all the top executives. There's a bunch of middle range people, and some of them are more important than the top executives, quite frankly. And they haven't seen the big increases. Certainly nothing to keep pace with 10% annual house price increases. So they're going to have to do something. And then there was always that thing. It goes back decades, but there was always that prediction that the Generation X, which is roughly 40, 45-year-olds today, I guess, we're going to really have a huge opportunity when the baby boomers all retire, because there's so few of them. So there's a huge number of people. The baby boomer range right now is about 56 to 74, say. There's a huge number of people right now that are 45 to 55 that are a cohort that's about to take over these key jobs, and they'll be able to demand big price increases because there just aren't that many of them. It's a smaller cohort than the baby boomer by quite a bit. And then the millennials are coming behind, and they're a very large cohort, but that generation sandwiched in the middle is, for whatever reason, turned out to be quite small, and they'll be able to command big salary increases, which leads into the topic in the financial markets of profit margins at corporations are at record high levels. So if profit margins, benefit from low interest rates, which are probably going to reverse with the high inflation numbers, low taxes, which are probably going to reverse with the change in the administration in the U.S., and lack of wage and salary increases, which is also starting to reverse. So profit margins are probably going to come down more to the long-term average, and that's quite a drop from where they are now. Roughly, I don't have the exact numbers in front of me, but the rough area is profit margins are bouncing around 11, 12%, but the long-term average is more like 7 or 8% as a percentage of sales. And so they're way above the normal range. And the tailwinds that they've enjoyed for 20 years, probably 30 years, are all starting to reverse at the same time.
There's going to be a kind of a big gap as things open up. All these small businesses that went bankrupt during the pandemic, is it going to take a long time, and are we going to see downtown cores that are basically ghost towns for a while? Well,
on Monday this week, I went into we have a team meeting actually twice a week of our team, and it's all been for 18 months. It's all been people working from home, but the offices kind of opened up now, and we actually have a brand new offices, beautiful office surroundings. And I hadn't been there more than 2 or 3 times in 18 months. So I thought, well, I'll go into the office on Monday morning at 9:30 when the team meeting is on, and I'll surprise them with my presence, And I got there, and I was the only one there. Everybody else was still at home, and they had this beautiful big office, brand new. Only had like 2 or 3 of us. Normally it's about 50 people that occupy those offices. So it hasn't happened yet. But what really struck me in relation to what you were saying is that the number of closures, like their Starbucks is still open, and there's 2 office towers side by each. But several of the big, like a whole Renfrew's closed, a whole bunch of places have closed because they just don't have the traffic anymore, and they can't survive without the traffic. So the landlord, and the buildings are owned by pension plans. Normally, that's the way it works. They must be really suffering at this point because, and then as the leases roll off, they're probably going to lose the tenant. Like right now, they probably are enjoying pretty high rents on a lot of their office space because the leases were signed 5 years ago. But as those roll off, people are either going to say, "Well, yeah, you have to give me, almost have to give me zero rent, or I'll just pay expenses, or I'll just leave." And so there's a crisis coming in downtown, and I don't think it's just Edmonton. I suspect it's all over.
Well, I saw that in Calgary they were looking at a couple of office towers and converting them to condos. But is there much of a demand for condos in Calgary?
Well, that's an announcement more than an actual reality, I think, in most cases, because when they actually get into the architectural design and construction drawings, they find out that the office towers are built very differently from condo towers, and so the basic construction just doesn't lend itself very well to condos, and that's problem number one. But the bigger problem, number two, is there's a surplus of condos in downtown Calgary. So I have one client who bought a house on the outskirts of Calgary, a nice big house, younger couple, and they're just having real trouble selling their condo because, well, partly because of COVID, but partly because there isn't the influx of people coming into Alberta like there was for the last 10 years. So there's going to be a surplus of condos. There's no point in it. The reason that people talk about those things is because there used to be good financing arrangements. Now the financing arrangements from CMHC are pretty much all for rental, purpose-built rentals. So where you build a building, it's purposely designed to be a rental building, not a condo. Saves quite a bit of money in construction. And CMHC will give you a wonderful deal, 1.5% interest rate, and guaranteed for 30 years or whatever. You can practically write your own ticket because they want to increase the supply of affordable housing, and that seems to be the only way to do it.
Is private mortgage insurance now surpassing the amount of insurance issued by CMHC?
Yeah, apparently CMHC's market share has really dropped. So it used to be roughly, when I did the first book, I think the numbers were roughly 60%, 30%, 10%. So 60% CMHC, 30% was the second company, and the company's changed its name. It's now called Sagen, S-A-G-E-N. And then a third one called Canada Guarantee was 10%. And so those two together made up maybe 40%, the private sector, and the so-called private sector, by the way. We can talk about that. And the government-controlled one was 60%. And I think when the head of CMHC, who's now left, and he's come actually to head a pension plan in Alberta called AIMCO, when he decided to do the right thing and tighten the restrictions on what people could afford to borrow for their houses, the two private insurers did not follow him. They kept the loose arrangements and kept doing 30 years and all kinds of special deals, and so because most of the people in the last couple of years really just don't qualify for the houses at the house prices they have, they all switched over to the more flexible private sector insurers. And when you have a small down payment of 5%, you have to have a mortgage insurance. That's a government rule. So they all headed over there, and CMHC lost a tremendous amount of market share. And now they've changed the CEO at CMHC, and the new person says, "Oh, we're going to go back and we're going to compete." But the whole thing is crazy because the two private sector insurers are not really private sector at all. No company could afford to insure that many mortgages from default because with a 5% equity and a 95% debt, the margin for error is too small, and they would lose billions of dollars, which they don't have billions of dollars. So what happens is the government guarantees 90% of the losses at the two private sector ones, and 100% of the losses at CMHC. So it's only private sector in name only. So it's quite irksome and actually quite dangerous that the government allowed, when CMHC did the right thing, allowed the private sector people to continue to do the wrong thing. And that's what probably led to a large degree to this latest boom in the house prices, the big increase in the house prices, which will only make the ensuing crash even more dangerous and more difficult for many people. So I'm a little bit irked. I'm more than a little bit irked about that whole thing. I think the government has handled it very poorly. And CMHC tried to do the right thing, and they weren't allowed to carry through on it.
We'll have more with Hilliard MacBeth right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, there was a suggestion from the real estate industry that the government should lower land transfer taxes in an effort to boost the economy. Would that work, and is it necessary, and is it a good idea?
Yeah, I don't know. It's not such a big deal in Alberta. It's a big deal in Toronto. I know because I think there's two land transfer taxes in Toronto. There's a provincial one and a city one, but it doesn't seem to stop the housing boom. So I'm skeptical of the impact that would have. They keep tinkering around the edges. They say, "Oh, we got to build more supply," and but you could look at the housing starts. They're at record high levels. They've stayed above the long-term average for the last 11 years. So it's unlikely that that's the case. Although maybe we're building too many condos and not enough houses. You could argue that, but it's not really supply. The main thing is demand, and the main thing that drives demand in housing is the ability to borrow debt. Because when you think about it, if all of us had to wait to save up the money to buy a house, whether it be $500,000 in Edmonton or $1 million in Toronto or $1.2 million or $3 million in Vancouver, it would be a lifetime of savings to get there, especially today. So the debt is what drives the market, and the market needs new debt all the time because the new people coming in with the money are what help absorb the demand. When one person that owns a house sells a house and buys another one, it's very little incremental difference in the amount of investment in housing. So those first-time home buyers, and they all need a lot of debt. Probably in many cases, 95% debt, or they borrow from their parents or their grandparents or whatever. But it's all debt, and so the simple solution to the whole thing is to say, you know what, you can't borrow more than 3 times your annual family income combined, right? And so if a couple is making $100,000 combined or $120,000 combined, they can borrow $300,000 or $360,000 to buy a house. So everybody says, "Oh my God, they can't afford anything." Well, no. If you make it a mandatory rule across the board, they'll be able to afford it because the house prices have to come down to what they can afford to buy. Right? It doesn't work that way. It doesn't work that they have to go up to where the house prices are. The house prices have to come down because there would be a huge surplus of supply of new housing and used housing on the market if all of the lenders were ordered by the government to cap it at 3 times, which is what I recommended in my the second edition of my book. And now, when the government goes to people and says, "Well, what do you think? Should we do this?" sort of behind closed doors, the answer is, "Oh my God, no, you can't do that. It would destroy the housing market. The housing market's 15% of the economy. You can't do that. That would be a disaster." And the government backs down. But it's a simple solution, and it would work. And there would be some people hurt, obviously, baby boomers that were living on, the equity in $1 million home that they paid, $5 for 100 years ago. But the rest of the people would be helped because they would be able to buy a house instead of having to pay $600,000 or $700,000. They'd be able to buy a house at $300,000 or $400,000 because they're all competing with each other with borrowed money to buy these houses and pushing the prices up. So if they weren't allowed to borrow as much money, they wouldn't be able to push the prices up as much.
It's one of the reasons why it was hard to find an affordable house during this post-pandemic real estate rush is the fact that there weren't any foreclosures. But that's going to change with the regulations, I guess, easing or the regular regulations coming back into the fall.
It's interesting that the whole thing has been unprecedented in that's an overused word, but it really is true in this case. So when they did the mortgage deferrals, that had never been done before. It's a 6-month deferral. Then they did the transfers of money into the bank accounts of individuals. That really has never been done on that kind of scale before. When the government ran a $340 billion deficit, which is like, 17% of the Canadian economy or something like that. That had never been done before. None of that stuff had ever been done before. And what it told people was, hey, just keep on buying more real estate, go out, and then obviously, I can't prove this, but obviously the word went to the banks, say, keep lending to these people, even though they might not have a job right now. When the pandemic's over, they'll go back to their old job. So don't worry about that so much, just keep lending to them. And so that's what they did. And then obviously, talking to people in Toronto, there also was a lot of co-signing of mortgages by parents and grandparents that helped get everybody through. So the thing just carried on. It's absolutely flabbergasting to think that in the worst recession since the 1930s, that house prices actually went up and mortgage debt grew by almost a record pace. At one point, towards the end of 2020, mortgage debt was growing at 12% annually, and it's still growing pretty substantially in Canada. Although it's interesting, in the U.S., it's completely stopped growing, which is very unusual, except in recessions. So we've tried this experiment, and the next step on that, as you pointed out, and your question was, what about these people? Will they be able to avoid foreclosure once all of these supports come out? And I don't know. The banks have a lot of flexibility as to when they foreclose. So, for instance, CMHC allows a 1 year, not 1 month, not 2 months, not 3 months, one full annual calendar year of being in trouble with your house before they insist on foreclosure. So there's a lot of flexibility in the lending area. And generally what happens is the banks wait until the economy is recovering and the economy's going, humming along at a pretty good pace, and then they start foreclosing because then they know they can sell the homes fairly easily, and it won't affect their bank profits too much because they will be making profits from their other businesses. So that's what's happened in the past. I don't know what's going to happen this time. It's very, very odd how this whole thing is being handled, and I think they would have been, my opinion, it doesn't matter what my opinion is, but my opinion is I think they would have been way better off to take the hit in March of 2020, because everybody would have said, oh, well, that's understandable, it's a pandemic and all that, and so on and so forth. But when they start, if and when they start announcing big foreclosures and big losses on some of these loans, in 2022, let's say, people will be saying, what's that about? Why are you getting into trouble now? The pandemic's over. But that also is could very well be what happens.
Hilliard, how's real estate doing in Edmonton and Calgary? Is it booming like the rest of Canada?
Well, there was a boom on in Edmonton and Calgary, sort of a mini boom, if you like, and it was pretty strong there for a while. There was every listing that went up seemed to be selling, but just in the last 3 or 4 weeks, and I understand this is happening in Toronto as well. Things are not selling as fast, and in fact, in Toronto, I was corresponding with one of the mortgage brokers there, and he said that the house inspections have come back. So for a while there, if you put subject to house inspection on your offer, you're laughed at, right? So now people are actually demanding a house inspection, and what that does, of course, is it brings prices down a little bit because people find flaws and they say, oh, I want a 5% reduction in the price because I found this flaw, and but it also is an indicator that things have slowed down. I think things are slowing down quite a bit, and the other thing that's happening is there's a huge number of new listings coming up because people have seen what's happening and they realize now that the pandemic changed their financial futures quite dramatically in some cases, especially in Alberta, but probably everywhere. And so wouldn't it be nice to capture that profit on the house right now? And it took them a while to get to that point, but now they're starting to think that way. So there's a bunch of listings going up, and now, unlike 3 or 4 months ago, now they are sitting. They're not selling right away the way they were.
Hilliard, thank you so much for chatting with us.
Nice to be with you.
My guest has been Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethmcleodpartners.com. Find him on Twitter at HMacB. If you have any questions for Hilliard or any of our other guests, we'll ask that question for you if you send it to info@housestreet.com. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at House Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.